welcome you back here today. This is a lecture on the Federal Reserve System and its role in the financial crisis, the response of the Federal Reserve System to the financial crisis. Like we said many times during the course of studies in the financial markets and things like that, what we did in these almost 4 months now, we did a lot of the things which were dealing with international financial system, international financial architecture, and I believe that these things were really helpful for your understanding of the global financial system, of the global financial architecture and the global currency system, the world system of currency, which is really the thing which we discussed and many times we said about the policy responses, about many issues of contemporary central banking and how it works. The central banking system became one of the most important institutions in the economy, in any economy, in the United States economy, in Russia. They're particularly important because they take part in the global liquidity and the global reserves, and they may influence these gold reserves, foreign exchange reserves, because these countries, the United States is the issuer of US dollars. Russia holds US dollars in its vaults, in the central bank's vaults, on an account, and this account can be used in order to maintain Russian policies, in order to maintain national projects and things like that, which we need for the development of the Russian economy and its industries. The United States does not hold much reserves, and it is quite understandable because the United States is the country that issues US dollars, so that means it does not have to maintain many reserves, much money in its reserves. This is usually a really symbolic, a very modest investment, so to speak, about $100 billion. This is not much. So we stopped last time at thinking about the companies and the financial institutions that would have collapsed but for the US Federal Reserve System, which came and it bailed out these banks, which are really the most important banks in the United States, such as AIG, Washington Mutual Bank, Wachovia. The only major bank in the United States that was let go bankrupt was Lehman Brothers. It filed for bankruptcy and it went bankrupt. And until this day, this company has not restored its activities in the financial market, so it is really a lost institution. It perished in the financial tsunami in the financial system, in the United States banking system. And this bank was more than 150 years old. That was a really great bank with great creditworthiness and trustworthiness of its clients. but still it collapsed, and it proved, well, they wanted to understand the working of the of today market economy, because market economy is actually a system which allows bankruptcies, and this is important in this market system, that banks and companies go bankrupt. There's this formula, bail-in or bail-out. So in the market economy, bail-out is sort of a government policy, a government policy tool. And in the market economy it cannot be used. But bail-out formula is used much more frequently, and that's why the market economy which we have is not really a market economy in the particular sense of the word, in the precise sense of the word. It is actually a system that combines some of the features of the command economy and the market economy, and in that sort of way it works. Well, there are other things which can be considered from the functioning of the Federal Reserve System in the financial crisis, and now we're going to go over to studying and understanding the lessons from the Great Recession, and specifically we'll talk about some of the lessons which were taken from the Great Depression of the 1930s, the late 1920s and early 1930s. And these lessons, as we'll understand, can be taken as a policy tool for the Federal Reserve System in today's situation, and in order to prevent future crises from happening again, so that sort of crisis did not happen again. The crisis such as we had in 2008, 2010, they are really that crisis was really damaging for the world economy. Like we studied many times, the central bank is actually a structure, an institution which must provide cash freely and give it to the companies, households, and many other economic units. And you should give them money freely. You should really give them that freely, because if they take it, they may survive the financial panic and financial tsunami. But you give money only to those institutions which are credible enough, and their assets are credible enough, and their long-term assets are quite insured and of good quality. So you exchange your long-term assets of your company for the short-term cash of the Federal Reserve System, and the Federal Reserve System takes that collateral, because actually it should analyze it first. It analyzes the quality of these assets, and it says that this company or this bank is really a good institution. It provides good long-term assets, and these assets are insured. And then, of course, there's this highly accommodative monetary policy, which helps support economic recovery. and employment of the population. This is one of the most important issues in any economy: inflation and unemployment, economic growth and current account balance. These sort of things, these four things, are the major indicators in the economy. Economy is said to be functioning really effective if it has economic growth, some sort of 2 to 5% a year GDP growth. Unemployment not more than 5%, which is a natural unemployment rate. And then of course current account balance, which is current account surplus. This is also a really important thing, so that your exports exceed imports and you take that surplus and you use it for some of your economic purposes or policies and things like that. And of course inflation. Inflation is a really serious thing in the economy, because if prices soar really quickly, and the rate of or CPI, the consumer price index, is really high, that means the population is really suffering from such an increase in prices. Inflation eats out the disposable incomes of the population. Things, and people usually do not trust institutions and the government when it develops this idea that the economy is not working really good because of the inflation, and inflation rate of 10% a year is quite high, and it harms economic activity in the country. It raises prices. Actually, sometimes we say that an increase in prices is really good for businesses, because it provides profit in the short term. But in the long term, inflation such as this, 10% a year, is quite damaging, and it leads to devaluation of the currency, it leads to unemployment, it leads to many other negative things in the economy. And sometimes we feel the population feels about inflation really, in a way, it considers it a really negative thing, because again it eats out the value of the money we get as salary or as wages, and we come to conclusion that our real disposable income is really small, whereas wages and salary is quite the same, remains the same, or even drops due to unemployment and due to instability in the labor market. So these are some of the policy responses. Other policy responses include using the lessons of the Great Depression from the late 1920s and early 1930s, when the Federal Reserve did not act so effectively as it should have been doing. It concentrated its efforts on bailing out big banks, and in that way it sort of created some of the problems of trust to the banking institutions, and it caused a wave of claims. It led to a number of trials, economic trials in the United States and elsewhere. And these people, usually the corporate leaders, so CEOs and people such as these, major businessmen in the financial world, were called upon to come to assizes, and these assizes just took some important decisions about the functioning of the financial system in the United States and elsewhere, and they understood that they should really focus on the things which were discovered during the Great Depression, to use that experience more widely, and they really used it to a good purpose, to a good reason. They came together in G20 meetings. They met several times during in the course of the last almost the last 10 years. So they started these G20 meetings in November 2008, then there was a meeting in April 2009, and then they met each year, and they still meet to they still come together to decide upon very important policies in the global economy. And these policies are usually concentrated upon things such as stabilizing the financial system, stabilizing foreign exchange rates, stabilizing gold prices, stabilizing financial markets, foreign exchange market, various stock exchanges across the globe. And these financial institutions were really undermined by the economic crisis, but the major financial institutions, international financial institutions such as International Monetary Fund, World Bank for Reconstruction and Development, and things like that, banks such as these, they came together and they created many funds to support countries throughout the world. They supported both the developing countries and the developed countries, advanced countries of this world. But the thing is that they supported mostly governments and countries from the developed world, from in Europe, in government institutions, the European institutions, government institutions, and some of the institutions, government institutions in countries which are of interest to the World Bank. And this bank is actually, its capital was really small. They needed a new support, and they prevailed. Their arms fell so ill that these things can be considered really important when it comes to understanding the workings of the financial system. When the system is ill, when the financial system is not really healthy, that means everyone in the economy, including governments, corporations, private individuals, households, they all suffer from economic losses, and these losses are created by the financial system collapse or being on the brink of collapse. Similar actions, such as we have described, such as we've said and mentioned previously, which included things such as providing cash freely. So these sort of things were really important for the national banking system, and they were taken by foreign central banks and governments in many other countries across the globe. And the global response to the global financial system was the goal of it was to stabilize the world financial system, because there were some ideas about the US dollar not being able to support the global financial stability. Some economists said that it is really difficult to restore confidence in the banks, but they should do this. They started restoring banking confidence during the crisis. It is really important to start reforming the things in the financial markets during the crisis, not after the crisis. After any sort of crisis, it is becoming really difficult to support the economic and financial stability in the economy. So that means that each and every country in the world should really focus its anti-crisis policies and should really compensate some of the negative things during the financial crisis, because when they use their resources during that period of time and they mark the insignificant damaging association with other financial institutions, they created a list of the very of the most important, systemically important enterprises. And this is a list of 28 to 29 banks, and these banks come from various countries, especially the United States, Japan, Germany, England and France, and China as well, in the developing world. These sort of banks are included in the systemically important enterprises, systemically important financial institutions, GFIs, like they are called for short. And these institutions were allowed to complete their recapitalization process, so that in the end the result would be that these sort of policy would lead to a more complex ideas, more understandable ideas about the system and how it works. One other thing which was really important in supporting the United States financial system and the global financial system was ensure access to financial resources, including things such as injections of cash and short-term liabilities. And so restoring financial confidence, restoring confidence in the depository system was really important, just like it was in the 1930s when Roosevelt came to power. He actually announced the creation of the federal FDIC, Federal Deposit Insurance Corporation. So he set up this corporation in order to ensure deposits of the population of the United States. His government, his administration was behind that sort of thing. which was really good for the economy. It helped a lot. And nowadays, during the crisis of 2008-2010, again, that tool was used really effectively, and it created lots of confidence in the banking system, and the people started buying homes again, just like they did before the economic and financial crisis. They were really sure, they understood the importance of the financial institutions' confidence and credibility and creditworthiness. And this is the reason why the government, why government financial institutions really insisted on recapitalizing those banks and financial institutions. Recapitalization actually means that your assets and your capital, the capital of your bank, should be really restored, and your required reserves, the required reserves of your bank should be really big enough in order to save, in order to bail out the systemically important financial institution. And this recapitalization process is going to happen in the course of several years. The first review of the recapitalization results is going to be in 2018. This is the year when these institutions are going to be proven and audited, and the auditors should say, or the auditors are going to say, maybe are going to renounce their opinion on their creditworthiness. Today, the highest rank in the recapitalization process is taken by two banks, which are HSBC, Hong Kong Shanghai Banking Corporation, and JP Morgan Chase. So these two financial institutions, these banks, are said to have the most, the majority or the highest degree, the highest share of their assets, and these assets are of good quality, but still they're long-term assets. And when these companies, these banks, are on the brink of bankruptcy, they may sell a package of their shares to the government or the institutional system, which is called the Belkin stories and things like that. So they should be really working together to ensure and normalize credit markets. Again, credit markets are really important for the economy because they provide cash, they provide liquidity in the marketplace, and this liquidity is sort of important because it's investment in the production process, in the process of developing some new ideas, technology. Actually, financial capital can be used both negatively and really positively. A positive way of using financial capital is that it provides cash and it sponsors research and development, or R&D. And this is really crucial for the economy when there are R&Ds being created in the economy. That means that the economy and its enterprises are increasing their rate of economic growth, and this economic growth becomes the basis for the development of the economy and GDP growth of the entire country. If you do not invest money into that system, in those financial systemically important enterprises or engineering companies, your economy is going to suffer really. It's going to be really difficult to overcome these financial problems and these financial issues of the system. So this is a really important thing when you give credits to households, to companies. For example, that gives them the opportunity to purchase the things which they produce, because during the crisis goods are not purchased to the extent that the company produced them. So the amount of goods being produced is much bigger than the amount of goods being consumed, because people are concerned about other things during the financial or economic crisis. They feel miserable and they do not have enough money to buy the goods and services they usually bought before the economic and financial crisis. But when you provide cash to the population, when you provide cash to other financial institutions and corporations, this money is used really effectively, and this money sometimes helps great enterprises just to walk after that. And this system is going to be a really effective system, which is going to provide cash to the financial and manufacturing companies and many other institutions. Then, of course, a really important issue which was not discovered during the Great Depression of the 30s was that in 2008-2010, during the financial crisis, the global financial and economic crisis, they used this international cooperation system. Just like, as you know, the institutional framework of the global economy is really taken by the IMF, the International Monetary Fund, the World Bank, World Trade Organization, and organizations such as these, the United Nations Organization. And these organizations are used in order to create some sort of financial framework which would help the economies of the globe survive this financial tsunami, to withstand the financial tsunami, which is usually a great thing to do, because again it helps the countries themselves to provide for entrance. And this sort of way helps to understand that international policy response, international cooperative efforts are quite important issue in today's conditions, because the global economy is interconnected. Everything is connected to everything else. Each company, especially international companies, and especially countries which are really dependent upon their exports and imports, like Germany, it is really it depends upon both. It depends both on the imports and exports. On the import side, Germany is dependent on the world trade and export-oriented economy, because they send these goods and services over to foreign markets and they sell them there. and it brings lots of profits because European countries are really saturated with these products and they are not in demand. But in other countries they may be of some sort of demand, and in this sort of way they're used to think a lot about various institutional frameworks when it is really understandable that the international financial system cannot work without these institutions anymore. The International Monetary Fund is responsible for Washington Consensus, which is a policy tool which is used to introduce some very important policy tools during the depression such as this, during the crisis such as these. They provide structural adjustment policies to other countries. They develop projects. They form up a group of people, usually professionals in their field, and they help. Another facility which was created during the financial crisis was a discount window. This sort of window helped the economy a great deal. It helped the economy not only of the United States but also the world economy, because this discount window was actually a policy tool that allowed providing cash opportunities to financial institutions and households and companies and other sort of manufacturing firms and non-manufacturing firms. So they provided again short-term cash to these organizations, and they provided them with these money really freely. And sometimes they did it at discount rates, which was really important. It's just a scheme that works like taking some or issuing some bonds, euro bonds, for prolonged periods of time, something like 30 to 40 years, especially to governments, especially to sovereign countries in the world. They helped a lot by discovering a new way of dealing with the financial crisis when they just almost they actually reduced rates and real rates in the economy, real interest rates dropped dramatically, and in some cases they were just under zero, so they were negative actually. That means money was given almost for granted. Money was given for free. It was an extremely loose monetary policy of the central bank in the United States. Many economists thought, and especially the Obama administration and his economic advisors, thought that in this way they're going to help countries and companies in those countries, especially in the United States. They provided them with cash opportunities, and that policy tool was really effective because no one actually feared about taking expensive credits. This situation continued long after the financial crisis, and actually during that financial crisis firms and other financial institutions really used their power to overcome some of the most important difficulties in the economy. As the crisis built, as it intensified, the maturity of discount window loans was extended and the interest rate reduced. And like I said, nominal interest rates were really low, but the real interest rate was extremely low. It went beyond, just went below zero. Real interest rates were negative. Inflation, why they did this thing, how could they do it so freely, why did they feel so sure about the things in the economy which were occurring in those days, at that particular time? Was that inflation in the economy was really slow. Inflation of 2% is a good thing for companies because it increases profits in the short-term period, and this short-term period is characterized of transaction costs, which really go down due to that sort of international financial negotiation process, when these countries, when the most developed countries, the group of G most important countries in the world, came together for G20 summits after 2008, and they provided opportunities for companies and households to understand the workings of the financial institutions, as well as many other economic activities, which led to economic growth in the end. So they were not afraid of inflation, they were not afraid of really high inflation rates, and they felt sure about that, and this is the reason for a very loose monetary policy. Credits and money were really cheap, and that was a loose monetary policy, and again it led to it did not lead to financial difficulties. It was later on, in the late 1980s, early 1990s, just before the collapse of the Soviet Union, there was the United States and the European countries were almost on the brink of financial and economic crisis. But the fall of the Soviet Union actually helped them overcome their difficulties, because all these German companies, Opel, Mercedes, Volkswagen, they all came together and they went on a spree, so to speak. They started their expansion in the Eastern Europe. Eastern Europe became a really a place to invest, because there were not so good functioning enterprises, and those enterprises were really it was really quite understandable that those enterprises could only be saved under some sort of government-sponsored programs and plans. And these government-sponsored plans and programs included financial packages, austerity measures, and things like that. Austerity measures were important so that budget costs could be reduced. Budget usually supports many enterprises just by helping them, but this time it's going to barrel the items that did not make a really great difference to them. Regular auctions of discount window funds were conducted to encourage broad participation by financial firms. And that is the final point in the discount window practice. So that means that some regularly done things in the economy were really needed in order to overcome financial difficulties of these sort of financial institutions. And these financial institutions were really an important part of the year's economy, so that it means no one was really interested in letting them go bankrupt. But there was still some really important cash flows, and that often hit grey fish with golden opportunities, and the gold market for the development of those financial activities. Gold stabilized and the US dollar stabilized. Actually, 1 ounce of gold costs something like 1,200 1,100 shares, or something like that. 1,000 shares, and these sort of shares really helped the financial system, the financial corporations overcome financial difficulties in the US economy. And then there were special actions by the Federal Reserve System. There were several new programs which were introduced in order to create more confidence, more creditworthiness, and trustworthiness, and things like that. They actually found themselves rugged in understanding the workings of the financial system today. And this financial system could be called robust only under the condition that it was really supported by government cheap credits and discount window. These financial programs were targeted. Their goal was to provide cash in order to solve liquidity problems. Problems with liquidity were really important, because liquidity is the blood life of any financial institution and any monetary system in the world, a monetary system in any country in the world. Because again, if you do not have much resources, if you do not have much financial resources, that means you're going to fail, because again, these sort of things are not done usually. And this sort of collateral which was taken by the Federal Reserve System was used as a guarantee, as a banking guarantee that this institution. During the Great Depression, the unemployment problem was much more acute than that of the 2008 world financial crisis. The world financial crisis and the policy instruments, the policy tools which were used, helped to actually minimize the negative effects of the unemployment. But still, unemployment was really high, 9 to 10% across the advanced countries. In Germany, it actually exceeded a 10% level. France and many other countries, especially the southern countries of the European Union, south countries such as Spain, Portugal, Greece, Italy, they all became they all had those really high unemployment figures. In Spain, the unemployment rate among the young population especially was more than 50%. And that was really damaging, The young people did not know what to do. They graduated from their colleges and other financial institutes and economics institutes and sort of other educational organizations. They just did not know what they were going to do. And in Ireland, I think Ireland was the country which was the most important in terms of providing cash opportunities. And in 2006, its financial system collapsed due to housing prices overheating. The economy really was really hot, and nothing could prevent it from collapsing. So in 2006, Ireland collapsed, and it caused a great rate of unemployment. Unemployment figures were something like 80% of the population in Ireland were unemployed, were jobless, and that was a social and economic catastrophe for the Irish economy, because if you do not work for more than 8 months, your skills start to atrophy, and that means you're going to take some really important opportunities, some really important tests, and you should go to college, you should get new education, or just get new qualification, because that sort of system, the system which we created today, the level of the financial system which we are working in, which we're working for, actually these financial institutions require very qualified people, very qualified brains, so to speak. And these brains were suffering. They could not find job opportunities throughout the world. And especially, like I said, the unemployment rate was really high in the South European countries. But especially a really difficult situation with unemployment was in Ireland, with 80% of the population, working population, unemployed. That was really a great blow to the Irish economy. But still, today, 10 years after the financial crisis of 2006 in Ireland, they recovered a bit. They've got economic growth, and this growth is an export-driven growth. That means that they produce really competitive products to the world economy, and the Irish are returning to their previous path, which was again created due to some European economic policies. The European government, the European Central Bank, and many other financial institutions provided cash opportunities for the Irish banks, and they sort of understood the flag quite well. He thought, we'll develop a new concept of creating some government-sponsored enterprises which are going to help the economy recover. And these new programs were sort of quite understandable, because again, without government help, without government sponsorship, these institutions could not be saved. So again, the formula bailout works, and the formula bail-in is not working in the financial system, in the market system, in the economic system of contemporary states. Why? Well, the thing is that especially in Europe, maybe this problem is really acute in Europe. In Europe there are banks, for example Deutsche Bank, which is the largest one of the largest financial institutions in Europe. Its capital, the capital of this bank, all its assets in value exceed the German GDP, more than 100% of GDP. That means if Deutsche Bank collapses, if it's going to go bankrupt and there's going to be a run on a Deutsche Bank and it collapses and it announces, it files for bankruptcy, that means the economy of Germany is going to collapse as well. The situation is quite different in the United States, where banks do not have so much capital. For example, Goldman Sachs's total assets do not exceed 15% of US GDP, and if it is let go bankrupt, if it's let to come to the brink of bankruptcy, to the brink of collapse, it means almost nothing to the United States economy. But again, it concerns one bank. I was talking about one bank, but if each and every bank, many big banks are going to collapse, what then? The banking system is going to collapse as well, and the population, the consumers, companies, no one is actually they won't be able to take credits, they won't be able to purchase goods and services, and nobody is going to have cash opportunities. So again, the formula bail-in is actually, it is quite understandable that in the market economy we should use this particular framework, this particular scheme, bail-in instead of bail-out. When a company saves itself, it comes to its help itself, and a bailout is usually government intervention, and that means if government intervenes in the economy, that means that this is not a market economy anymore. We should really be thinking about things to provide the economy with more economic and financial tools that would help economies and the banking system, banking institutions and financial institutions survive the financial tsunami, and this is really important. And again, bailout is a formula which is preferable for the economy, because it's taxpayer money, and you may criticize the government for using these sort of financial resources not really effective, because this money belongs to the general population, because the population pays taxes, and really high taxes, especially in Europe, and countries such as Germany and France and many other countries, Sweden, countries such as these. So it is true, but if they let all their banking institutions and financial institutions collapse, that would mean the collapse of the entire financial system. And these banks in the developed countries, in the advanced countries, the banks, financial institutions are the most important enterprises or globally important financial institutions. Generally or globally important financial institutions, and you should not let them go bankrupt. So again, formula bailout is more preferable. And then, of course, governments. There are some countries in Europe whose debt is, whose government debt is so big that one economist, a German economist, Hans Werner Sinn, the director of Wirtschaftsinstitut in Germany, so he said that if you just imagine one country, such as Luxembourg, these countries, just one financial tsunami, just one wave of explosion of financial tsunami, and this country is going to collapse. Then the Federal Reserve System also, it also created special liquidity and credit facilities. His purpose was to stabilize again the financial system, to enhance the stability of the financial system, to promote availability of credit to the United States companies, United States households and businesses, and thereby support recovery. And that was the traditional, that was a sort of traditional element, the traditional function of the Federal Reserve System and any central bank actually, which again should serve its role as the sort of the lender of last resort function. It's this function, the lender of last resort function, is really important, like we said, during the financial crisis, because the central bank's target, the central bank's aim, goal, is to provide cash to the financial institutions, to banking institutions, manufacturing companies, in order to help them get back on their feet. And that sort of function is really helpful, because sometimes there are things which cannot be done without central banks. And this sort of situation, this financial tsunami, can only be stopped by things such as injecting cash into the financial system, into the financial markets. And that sort of funds are going to be used directly in the financial system, and they would help the system continue its operations during the financial crisis. So do not let many bankruptcies, this is the issue taken by the Federal Reserve System. They quickly realized, and that was really important, that they did it really quickly. They realized that liquidationist theory of the 1930s was really bad for the economy, and that during crisis you should really provide cash to all the institutions, oil working institutions in any country in the world, and just you should take that budget rule, give free cash to the population and those other sorts of things, and help the recovery of those institutions. The recovery actually started, the US economy started its recovery. There is an institution, Statistics Bureau, National Statistics Bureau actually in the United States, which tells exactly the dates when the financial crisis or economic crisis starts and when it ends. And that recession was almost the largest recession in history. It did last starting in 2007 over to 2009. Spring 2009 was when the United States economy started its recovery. And today, the United States economy is actually growing at a moderate rate, at a moderate economic rate. But still, for a developed country such as the United States, 2 to 3% to 4% is quite enough for economic growth. China is also experiencing recovery. Actually, the economic crisis in the BRICS economies was not so harsh. The hardest hit economy was Russia. It lost 10% of its GDP during the first year of the world financial and economic crisis of 2008. By 2010, the Russian economy started to recover a bit, and it regained some of its losses, which were incurred in 2008-2009, especially late 2008, early 2009. There were really great problems with the Russian economy. Manufacturing process collapsed almost. There were reductions in salaries and wages. Enterprises such as auto manufacturers especially, they just discontinued their production processes. For example, Gas Group of Russia discontinued the production of Volga cars, which was the landmark of the Russian automobile industry. Many enterprises were sold to foreign countries, such as Renault, Nissan, and many other companies, GM, Daimler-Benz, and other companies. So almost each and every enterprise of our automobile industry was sold to foreign companies. And again, there were really harsh problems in the manufacturing sector. It almost collapsed. But the agricultural sector actually it met with some very negative difficulties, but again, these difficulties were not so harsh. And the difficulties of the Russian economy proved to be really acute during 2014-2016. So we are now experiencing a period of financial and economic crisis, which was caused not by the world financial crisis, but some sort of political issues, political tensions between the United States and the European Union on the issue of the Crimea and the question of Ukraine being split upon, split into in many states, and Russia has taken a really hard position in that sort of conflict, and that was the reason for all those economic sanctions against Russian enterprises. But still, again, manufacturing companies suffered, but this is really important to say that some of the agricultural enterprises and actually the agricultural industry survived, and that is a really good sign for the economy to recover in the future. because we may provide wheat and barley to the rest of the world. We may sell our agricultural products abroad and conquer world markets. Actually, when we think about these issues, it is always important to understand that the financial crisis of 2008-2010 was really an important indicator for other economies to use much better economic policies, much more effective economic policies. And these economic policies included the function of the lender of last resort function of the central bank, and the budget's rule of providing free cash to enterprises and other financial institutions against good collateral and long-term assets, good long-term assets. So that was the issue, and I would like to conclude by saying that today we studied lots of the things which can be included into the government's, the central banking practices across the globe. These central banking practices include the lender of last resort function, some sort of discount window, again, international cooperation of central banks and providing cash to other countries in lines called swaps. These swaps could be used as credit lines to provide cash opportunities to countries in need, and to provide liquidity in order to maintain the financial systems and recapitalize banks. So these issues which we've covered today represent the basic policy tool of the most important policies of the most important financial institutions in the world economy. And this list was created in 2010, and this list includes 29 globally important financial institutions which could not be let collapse. And the government should take some steps and measures in order to maintain their functioning and use that formula bailout instead of bail-in. And in that sort of way it may help these